The 10 largest companies in the S&P 500 index now represent a greater percentage of that index than we've seen in the last 50 years. So in this video, we're going to do three things. First, we're going to look at that concentration. How bad is it really? How does it compare to trends? That's the first thing we're going to do. The second thing we're going to look at is, can we interpret that in such a way to understand what the market is going to do, say, in the next year or not? Does it have any predictive ability? That's the second thing. And then the third thing is, what, if anything, as investors, particularly those in and near retirement like myself, what should we do about it? So that's what we're going to do, those three things. So let's dive right in. And as always, I'm going to show you a number of things on the screen, and I'll link to everything I show you in the video, below the video. So let's dive right in. The first thing, let's look at just how concentrated the S&P 500 is. We're looking at an article from Goldman Sachs from March 21 of this year. And the first thing I want to show you is this chart. So this shows you what percentage of the S&P 500 is comprised of the 10 largest companies. And we go to the current, it's 33.3%. There we go. 33.3% of an S&P 500 index fund, let's say, is represented by just 10 companies. And you can see this chart goes back to 1985. And so over almost 40 years, it's the highest it's ever been. There were some times here recently before, I guess maybe before and after COVID period, where it was close to that. But even if you discount those, it's never been what? I guess the high point was, oh my goodness, the tech bubble. We all know how that turned out. It was only 27% then. And now they're over 33%. Now, we can dive into the details of those 10 companies. What I've done, this is Morningstar. I just typed in to find, in this case, I use Vanguard. I just typed in the ticker, which is VOO, and it brings me to this page. And then I go to Portfolio, which is this link here. And if we scroll down, we can see, top 10 holdings, they have it at 32%. This is a bit dated. This is as of February 29th. So it's actually gone up a tad since then. But it breaks down the top 10 companies. We can see Microsoft at the top with a percentage portfolio weight of 7.18%, all the way down to the number 10 spot, Broadcom, 1.33%. You add them up, you get to 32. So yes, the stock market, the S&P 500 is highly concentrated, both just in absolute terms, obviously when we look at history. Now, there are a couple of other things, though, we can look at to understand that concentration before we get to this number two, which is, does it have any predictive ability? So let's do that. First thing is, go back to this Goldman Sachs article. One thing to note, they track also what percentage of earnings per share, the top 10 represent. You can see today it's 25%. I point that out because if we go back to the tech bubble of 2000, earnings for the top 10 were much, much lower as a percentage. And if we think back, one could, in theory, take some comfort to say, yeah, they represent a big part of the pie, a big piece of the S&P 500 today, but maybe that's justified because they also are where the earnings are coming from. And these companies are making money, hand over fist, a lot of cash flow. So, maybe they deserve the valuations that they have. Now, there is another way to think about the concentration risk, if you will, and to look at it from an historical perspective. And to do that, I want to go to this article. And I understand this graph is a bit blurry, but bear with me. This is from Russell Investments. What they're tracking, they actually go back to 1964. And you're looking at stock concentration as measured by, it says HHI. Well, what in the world is that? Well, that's the Herfindahl-Hirschman Index. It's a mathematical formula that's used to measure the concentration of, in this case, we're looking at the S&P 500 index. It can be applied to other things as well. And you can see, using the HHI measure, we're extremely high. You have to go all the way back. They've even circled some of these in red, to the early 70s or late 60s or early 60s to get a higher level of concentration. But still, that puts today's numbers in stark contrast. I mean, we are extremely high in our concentration. But here's the other thing that this graph does that I like. You see these bars, I guess they're sort of a yellowish, I don't know, goldish, tannish. Those represent recessions. And you'll notice that a lot of these high points, here they circle them for us, right, coincide with recessions. And so there's this theory that extremely high concentrations in the S&P 500 index are often an indicator of recessions, number one, and two, significant drops in the stock market. This one caught my eye right here because this is just before the two really, really bad market years of 73, 74. And of course, most of us can probably remember the tech bubble crash, which is here, and the great financial recession, which is here. And so this sort of leads into our second question. Hey, does the current concentration of the S&P 500 indicate that maybe, troubled waters lay ahead and we're going to have a really bad either recession and or stock market crash, say, in the next year or so? Well, the answer to that gets a little more complicated. Certainly, we could look at this chart and think, well, yeah, maybe that could be an indication. And certainly, I think if that happened, I wouldn't be surprised. If you come back to the Goldman Sachs article, though, they talk about this same thing. Is market concentration good or bad? And they say here, Goldman Sachs research found that while investors usually think of elevated concentration as a sign of downward risk, and downward risk is just a fancy way of saying, uh-oh, and the stock market crashes, they go on, the S&P 500, right here they say, the S&P 500 rallied more often than it declined during the 12 months following past episodes of peak concentration. At least that's Goldman Sachs' take. Now, they're not the only one, though, that has weighed in on this. We can jump over to the S&P itself, right? This is from S&P Global. This is a recent report that they did. As you can see, its concentration, they're looking specifically within sectors. Think technology sector, for example. But one of the things I noticed in this report is right here. They say a simple way to measure market concentration is to add up the weight of the largest constituents in an index, right? That's what we just did, 33%. They said, interestingly, after peaks in concentration, such as the aftermath of the tech bubble, the S&P 500 equal weight index, so that's where all of the companies, you would basically invest in all of them in an equal measure, and there are funds that do that. I'll show you one in a minute, have typically outperformed its cap-weighted counterpart. So that's sort of somewhat contradictory, it would seem, from what Goldman Sachs is saying. When folks ask me this question, though, what they're really wanting to know is, what does the future hold? Yes, concentration is very, very high, the highest it's been in 50 years. Got to go back to, the 60s and 70s to find higher. What they're really wanting to know is, hey, Rob, what's the market going to do in the next 12 months? And for that, I have a very clear and definitive answer. I have no earthly idea. Which tells us what? Well, it gets us to the third and final point of this video, and I know you're probably grateful. What, if anything, should we do about it? So I want to look at a couple of hypothetical possibilities. So one would be to say, well, if the S&P 500 index is so concentrated, why not just invest in a total U.S. market index? Because that's going to take us from roughly 500 stocks to thousands, and we can look at that. If we go back to Morningstar, we can see this is the S&P 500 they actually have 505 equity holdings, but we'll just call it 500. And we see that it's, 32% exposure for those 10 holdings as of February 29th. Well, we can just put in a total stock market index. We'll use Vanguard as well, VTI. And we'll go to portfolio, which is right here. And we'll scroll down. The first thing we see, look at this. I know it's a little small on the screen, but 3,727 holdings, so much, much more diversified, but it's still cap weighted. So even though it's brought the number down, it's still at 28% as of February 29th. It's probably 29% today, and that's because it's cap weighted, and so you still have these large companies that make up a significant portion of the index. And so even with a total stock market index fund, it's still heavily concentrated. It might not give you, what you're looking for. So we could go, as the S&P Global report mentioned, maybe an equally weighted index will do better. given the high concentrations. And I can show you one. This is from Invesco. S&P 500 equal weight. The ticker is RSP. We could even, come over here and put it in Morningstar. Here we go. Whoops. There we are. And we can confirm. We'll go up here to portfolio, scroll down, and look at this. The top 10 holdings only represent 2%. Now, so one could look at this and say, maybe this is much better. There is sort of some reality, though, is that historically the S&P 500, the cap-weighted version, has outperformed. And I'm a big believer in coming up with a portfolio and sticking to it no matter what's going on in the market or in the economy, partly because I think, at least I'll speak for myself, but I think most people as well, we're really bad at timing the market. Yes, we can look at something and say it's got high valuations, or in this case, really high concentrations, but you'd be surprised how many times that's not really a good indicator of what's going to happen in the near term. Maybe in the long term, things revert to the mean, but in the short term, and that can mean in a year or longer, boy, anything could happen. So there is another way to diversify out of the S&P 500 or even a total stock market index fund, and that is to add either small cap or mid cap weightings without going to the extreme of an equal weighted fund like we looked at from Invesco. And that's something that I do. I have about 10% allocated to small cap stocks, and doing that at least softens the blow of the high concentration of the S&P 500 in times like this. That's not really why I do it. I'm just more comfortable long term having a little more exposure to small caps than what a total U.S. stock market fund or S&P 500 fund would give me. That deviates from the well-known 3-fund portfolio that the Bogleheads have made popular, and an approach to investing that I think is terrific. But I have deviated from it a bit with that small cap exposure. But there's another way that we can do it. We can also just go in and add international stocks, which I'm a big believer in. I know a lot of folks today say, oh, they haven't done as well in the last 10 or 15 years, so why have them? And the S&P 500 companies, they do business all over the globe. I get that. I'm still much more comfortable with some international diversity. And so I'll show you the fund I used. This is just what I use. It's certainly not the only fund. Maybe it's not even the best. But I use a couple, but this is the primary one. And it's just the total international Vanguard stock ETF, VXUS is the ticker. Of course, this is going to diversify out away from that concentration of the S&P 500. Again, not really the reason I do it per se, that is concentration risk in the S&P 500. It's more concentration risk in just US-based companies. But if we look at this, we can go to portfolio. In this case, first of all, they have 8,500 stocks, so it's a much, much broader universe of equities. And the top 10 in this case, of course, they look very different than the S&P 500, as you would expect. In this case, it's only 10% of the holdings. So a very different perspective than the S&P 500. Now, I'll mention a fifth and final way you could further diversify your portfolio, and that's alternatives. You could have additional exposure to REITs, maybe commodities, for example. Now, why do I say additional exposure? If you have a total stock portfolio, total U.S. stock fund, maybe a total international stock fund, you already have exposure to REITs and commodities directly and indirectly because of the companies that are in those indexes. So you already have exposure. Some would argue maybe you should have even more exposure, put 10% in REITs, for example, maybe 5% in commodities. I have done that off and on in the distant past. I don't do that today. I certainly think it can be a reasonable approach, but the key is ultimately, in my mind, is sticking with your portfolio for the long term as much as you can. What I ended up doing was moving away from that approach, mainly just to simplify my portfolio over the years. But again, I don't think an additional exposure to REITs or maybe a small additional exposure to commodities is necessarily a bad thing. Once you've done that, whether you use it alternatives or not, but once you have a well-diversified portfolio, what's happening with any particular asset class, frankly, doesn't matter so much. You're always going to have some that are highly valued, lower valued, high concentration, low concentration, did really well this year, did poorly this year. That's just the nature of the game with a diversified portfolio. And I think, we become better investors when we have that diversification, one, but then two, can live with the ups and downs that are going to happen with inside that portfolio year after year after year. It's just sort of the way it goes. So that's my take on it. Hopefully this has been helpful to you. If you have any questions, or I'd love to hear your own thoughts about the S&P 500 and its current concentration, and perhaps what, if anything, you're doing in response. Maybe the answer is you're doing nothing. I'd like to hear that too. Just leave them in the comments below. And of course, I'll be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.